Welcome to Profit Mindset. Here, we break down finance in simple words, from banks and bonds to stocks and the markets. If you want to truly understand how money works, make sure to subscribe. And now, let's begin. Every year, billions of dollars leave their home countries and move abroad. But why? Money doesn't just walk away on its own. In reality, capital always looks for the highest profit. That's exactly how England once built railways in Australia and Argentina, earning interest while other nations were still growing. In this video, I'll explain in the simplest way possible where money goes, why it flows abroad, and why it matters to all of us. Finance becomes international when money leaves one country and goes to another. This happens when investors lend abroad or invest in foreign businesses. But why does this happen, and is it good or bad? Capital goes abroad because it is more needed elsewhere. Other countries are ready to pay higher interest or offer bigger profits. For example, in countries like England and France, generations of people saved money and invested in industry, so their home economies were already well supplied with railways, factories, and ships. But new countries like America, Argentina, or older but late developing ones like Russia and China didn't have enough capital. They needed money for growth, so they were willing to pay higher returns to borrow it. We must remember, capital is not just money. It means property, goods, machines, transport. In England, money mostly existed as credit in banks, backed by real assets like factories and securities. Because earlier generations invested in infrastructure, England was rich in capital compared to younger nations. That's why English investors helped build railways in places like Australia and Argentina. In Australia, governments borrowed the money, promising repayment with interest. In Argentina, private English companies built the railways, taking the risks but earning large profits. At first, English investors disliked foreign investments. Traders were used to sending ships abroad, but lending money for many years to unstable countries seemed unsafe. Wars, revolutions, and bad communication made long-term lending risky. Over time, things changed. The system of limited liability made investing safer. Shareholders risked only the money they put in, not their entire fortune. That encouraged ordinary investors to put money abroad. There were failures, too. In the 18th century, financial bubbles like the South Sea Company caused huge losses. Later, after the Napoleonic Wars, many bad foreign bonds damaged trust again. Investors preferred home rails, thinking railways at home were safer because they could see their money. But gradually, higher profits abroad and growing stability in new countries made foreign investment popular. Before the World War I, England sent hundreds of millions abroad each year. But trouble came. Mexico stopped paying debts after revolutions. Brazil suffered when rubber prices collapsed, making repayment hard. Countries invented new funding schemes, paying with new promises instead of cash, which only grew their debts. Still, during the war, young countries selling food and raw materials to Europe became rich. They easily paid debts and even lent money to Europe. The US especially grew into the new world creditor, financing Argentina and even lending to England and France. The key fact: international finance is always tied to trade. Lending is not about sending gold, but about sending goods and services. Imagine a doctor in England investing in an Australian railway. His money buys rails, locomotives, and services. Every year, Australia must pay him interest. But it can only do this by exporting goods, like wool or wheat, which can be sold in England. So loans are always repaid with goods, not just money. If loans are spent wisely, for example on railways that boost production, everyone wins. The country grows, earns more, and pays debts easily. Investors get steady returns. But if loans are wasted, both sides lose. Before the war, England earned so much from trade, shipping, insurance, and interest that it could lend abroad and still import goods. After the war, however, it had to borrow from America. This weakened its role as the world's banker. To recover, England needed saving and hard work. The main lesson: capital always comes from saving and effort. Money abroad represents real goods and labor. International finance is not magic. It is trade plus interest.